Hello everybody. So today I want to cover 3 stocks, 2 that I don't own, 1 that I own, and on which I'll give you my thoughts about the earnings call that happened yesterday evening. So let's get started. Let's talk about Micron. So Micron is a stock that some of you have suggested to me in the comment section. When I look at Micron in my screener, it is very cheap at a 0.23 and a rule of 40 of 84. This is excellent, especially when you consider the size of this company, $87 billion company. So, I guess slightly smaller than an AMD, but almost comparable to, say, a stock like AMD or Intel as far as size goes. So that's quite impressive for a stock this established to be trading this cheaply. Enterprise value over forward revenue is only a 2x, and enterprise value over forward EBITDA is only a 7x. So this screams value stock, and this stock is also growing quite a bit. Still, analysts are expecting 42% forward revenue growth. But here's the thing. When it comes to Micron, it kind of has earned a reputation in the market as a swing trade, as some people call those, or cyclicality, but cyclicality really on steroid. And this is the stock chart here. I went as far as back as 2013 on this chart, 2013, and you can see it's complete madness. That's like roller coaster as it gets. I mean, I cannot imagine how many people got shaken out of this stock or got bored with this stock, because these are violent moves. This is violent volatility. But it's noteworthy that actually Micron, despite this roller coaster, despite the drop that we've had for the past, 7, 8, maybe 9 months. This stock has been dropping for 9 months now. Despite that drop, and it's a drop from more than 50%, it still has beat the Nasdaq. It beats the QQQ 21.5% and 17%. And I guess the question one has to ask themselves is, for 2.5% of outperformance over a 13-year period, is it really worth boarding that roller coaster, right? If you board a roller coaster like this, you would expect it to do twice the Nasdaq, not the same as the Nasdaq. I mean, to be shaken so violently, I would expect the performance to be much better over the long run. But here we go again for Micron. Micron has halved again. The value has halved again. So I guess it was a little longer than that. Since June 18, 2024 to April 15, 2025, we are down 53%. And why is the stock dropping again? Because, and look at this. This is the revenue, right? So this chart shows the revenue cyclicality. The revenue looks like a roller coaster if I've never seen one. I mean, this is like a crazy roller coaster, this revenue. And if you look at the last quarter, right, that they reported, the revenue started dropping. The quarterly revenue started dropping, which has precipitated, in my view, a decline in price in this stock because the revenue started dropping. And so are we going to a descending phase on the revenue for the next few quarters? Which, begs the question, where is the stock price going to end up if the revenue is actually dropping again? I think this company has proven that over the long run, revenue goes up, but with such crazy waves. If you look at the overview of the last quarter and the report, we are doing really well on DRAM, and there's a lot of demand for DRAM, but you'll see with what they call NAND, which is another type of memory chip, they're not doing as well, and they have overcapacity to the best of my ability. Oh yeah, I didn't even tell you what Micron does, right? Micron does memory chips for computer, DRAMs and NAND, and of course these chips, they're kind of a leader in the memory chip business, and these chips, GPUs need these, so they've renewed their business multiple times, but their business is getting renewed right now with data centers, because these data centers, these GPUs need Micron's chips for their memory. So So that's the plus, right? So why do I not like Micron? Why don't I own Micron as much? I'm not saying I don't like it, but I don't like it as much as other opportunities. Like right now, for example, I would choose Nvidia over Micron any day right now. So the roller coaster for me, it's too much because again, the outperformance is not seen when you compare it to the Nasdaq. So that roller coaster, a roller coaster like that, I really want to see crazy outperformance over the Nasdaq, not only 2% more than the Nasdaq. So that's an aspect. Q3 shows like there's going to be some deceleration. I don't know for how many quarters, but there's going to be some deceleration, and it's likely that the market's going to be like, okay, this stock is going to go into a bear phase. It seems like, and they talk about it in their report, that the demand for their NAND chips has moderated, as they say, has moderated. So they have less demand for one of their type of memory chip, and they say that they are very careful about the factory utilization because that factory is now in overcapacity. But what I don't really like about them is the dividends. So first of all, why do they have a dividend? I mean, sure, Nvidia has a dividend, but it's a 0.01% or something like that, 0.001%. This one has more than 0.5% of dividend. Why is there a dividend? I think they spend close to $2 billion in dividend. Why? I really don't get it. It makes very little sense to me. It makes no sense actually to me to have a dividend for a stock like this, especially if they're going to be growing and growing. And the timing of their buyback, I really don't understand. They pride themselves on having done buybacks. They did a bunch of buybacks last year and 2 years ago, and right now they're saying they're not going to be doing buybacks. Like they haven't guided for a buyback this quarter. So the stock is at 50% the high, and you're not doing a buyback. So anyways, I don't really like that. So that's one of the reasons why I'm out. What I like about it is that they're going to be manufacturing in Idaho, so in the United States, coming in 2027. Okay, probably a lot of capex here on that one, but still, I think when in the tariff tension world, this is going to be a big plus. And I think it's true that they have a robotaxi opportunity. If robotaxi takes off, these robotaxis are going to need memory chips, and it's going to be good for Micron. So that's what I like. But the conclusion for this is, for me, it's not for me. It's and I think I will reassess this stock if it drops another 50%, right? If it drops another 50%, it'll be 75% from the high. Then it will have entered the valley of despair. And this is a stock, if you look at the chart, let me show you again, it has entered valleys of despair multiple times. And so I don't know if it's going to be the low. I don't know if this is the entrance of a valley of despair or not. But I think this is a stock that I want to be in a valley of despair. I want to see it being in a valley of despair for like a few months, and then, maybe we've hit the bottom. So anyways, that's the reason why I'm staying away from it, even though it looks so cheap. Let's talk about stock number 2, which is Remitly, which is another stocks that my channel's viewers have asked for. Now, Remitly is cheap too in my spreadsheet, right? It's trading, 23 times EBITDA, so that's okay. That's cheap, but it's not too cheap. Enterprise value over forward gross profit is 4, so that's cheap. Enterprise value over forward revenue is 2.5, so that's cheap. Enterprise value over gross profit over revenue growth is 0.16. That is almost very cheap, and the rule of 40 is achieved at 48. What does Remitly do? They are in the payment remittance business. People living in the USA sending their money abroad in Mexico seems to be a big business for them, but not just Mexico. They do some India, they do some China. So anyways, the revenue growth in their business, the revenue growth has been as steady as it gets. It seems that like they're growing 30% year over year, and they're doing that same growth in the number of active customers as well year over year. So they're growing 30% roughly every year, which is a little more than 30%, which is excellent, right? It's above my threshold. And it seems like the way they're winning in their marketplace is the customer centricity. They seem to be having amazing reviews, great amount of praise. And for example, I compared it to their main competitor, their leading competitor, which is Western Union. And Western Union, of course, Western Union has so many reviews, so they are going to reach a 4.0. And remember, this is Google's Android reviewer, and a a 4 is not good on Google. Like, you want to be more than a 4. You want to be much more than a 4. A 4 is like the low end you can get. Like, and a 3.8, a 3.9 is really, really bad on Google. And when you read the 1 stars, you can see, glitchy app. People don't like Western Union as much. And in my view, Western Union is they're trying to eat the lunch of Western Union. And if I look at the third player in this business, which appears to be MoneyGram even has worse reviews than Western Union. So I think Remitly is trying to be the customer-centric app in the space, in the business. They're trying to be that customer-centric app and customer-centric app, and they're getting a lot of customers because of the customer service that they're able to provide. Uptime, all 99.8% uptime. 95% of transactions without contact support. And again, the funds disbursed in less than an hour in 92% of the cases. So these are the performance indicator. This is how they shine compared to the competition, and they've been taking a lot of the competition away, I believe, from a company like Western Union, which is not growing nearly as fast. They have their flywheel, and the flywheel is all about the customer experience. You can see it's the beginning of a flywheel. It's what leads to everything. Customer experience leads to better actions, leads them to select the service, and then the more they use the service, the better prices they can get. And of course, one of the reasons why this company can win is because it's a newer company, right? It's built on a modern day stack. They don't have legacy systems like a Western Union, and so it makes sense that they could take a lot of business away from Western Union. On the other hand, and this is yet again, unfortunately, a stock that I will not be interested in, it's because as someone who follows so closely the world of Bitcoin and the world of digital finance, I know that these businesses will also be disrupted at some point, because you are still built on TradFi rails, right? This is the best of TradFi. With the advent of stablecoin, I see a future where stablecoins could entirely disrupt this business. And if you have a stable coin, you can send USD to Mexico from USD in the US. And maybe at some point, people will just accept USD in Mexico, and that's kind of like my long-term thesis. So even if this stock were to say get super cheap, it would to me only be a medium-term hold, because in the long run, I really believe crypto is going to be the solution to a lot of these remittance issues, especially as you have new cryptocurrency wallets, for example, that are very user-friendly, right? Solana is super user-friendly. It's nothing like Ethereum and these awful MetaMask wallets that barely worked. Like today, the user experience today in crypto is getting better and better and better, and there's only one direction, in my view, where this is going, which is easier and easier and easier. Not to mention, I could see a country threat. Like I could see a lot of risks. What if one of the measures by Donald Trump, for example, is we're gonna tax remittance payments? Like, that could be something too. So I see a lot of risks, and the valuation is not compelling enough for me to jump in. And this is good, because now we're gonna talk about a stock that I own, and you'll see the valuation is a stark difference. So this was a 0.16, right? And of course, we want it to be as cheap as possible. This was a 0.23, for a world leading company. Now let me show you a company which is the cheapest company in my entire spreadsheet, which is BioStem, BSEM, BioStem. It's trading at a 0.008. So we're not even at a 0.01. So at this point, this stock is, it's at the very least 17 times cheaper. It's actually more like 25 times cheaper than Remitly, and maybe 30 times cheaper than Micron. And so it's a micro cap, right? It's a small cap, and of course, I've invested on this channel. I've covered stocks that are even smaller than this. So this is not the smallest of the small caps, point number one. But the reason why this stock is so cheap is because it is not listed on the NASDAQ. It is what people call a pink sheet, which means that your broker not only has fees for it, not only that, but you can't find it in most modern brokers with great UIs. If you have a good broker with a great UX, it's likely not going to be available. It's only available on the bulky brokers, and so unfortunately, I own it via the oldest broker I've been with, which it's awful. Anyways, the point, of course, is that at some point the hope is that this stock gets listed on the Nasdaq, and that's a big catalyst for this stock. And when it gets listed on the Nasdaq, wait 6 months, and then you can just transfer it to a modern broker. Anyways, let's talk about the business. So this business popped recently because the local coverage determination, which is the Medicare reimbursement schedule, which says does Medicare reimburse your product or not, that was postponed until January 1st, 2026, which means that they can keep printing money, and printing money they do at 97% gross margin. They can keep printing money until January 1st, 2026. This business does placenta bandages. So it's in the placenta wound care business. They call them allograft. They turn placentas into wound care solutions and wound healing solutions. So that's what they do. And why the stock is down? The stock is slightly down today compared to the pop of LCD is because analysts only care about analyst things, and this is so annoying. So there was an FDA warning letter, and the analysts were all over this. And the FDA warning letter was about a product that is getting discontinued by BioStem. And so I assume because we are discontinuing the product, that random inspection that the FDA did, they nitpicked on a product that's going away. And that product is being discontinued, and I don't even remember the name of the product, and the process used for that product is also discontinued. So that doesn't apply anymore, but they had to spend a large amount of time on the call to defend this. Oh, we got a warning letter about a product that we're not doing anymore. So that's point number one. Point number two is the analysts, really don't like the SEC negotiations on revenue recognition and on their Form 10. So they're trying to be listed on the Nasdaq, and so for that they have to have their books align with the rules of the Nasdaq. And there's a lot of rule arbitrage, rule negotiation that has to happen. And of course, that means that there's going to be some minor changes in different metrics that analysts have to input in their model. And the CFO said something really, really bad once an analyst pressed. The CFO said that the gross margin could change slightly. OMG, end of the world. Would we move from 95%, that's actually 95% this quarter, but for a full year it's 97. Would we move from like a high 90s gross margin to a low 90s gross margin? That doesn't make a difference to me. But analysts really, really, really care about that stuff. And frankly, 45 minutes this call was, focusing on minute details. The product was barely discussed. Like thank goodness the CEO spent the first 20 minutes talking about the product a little bit, but the product was barely discussed, right? How about talking about diabetic foot ulcers and how huge of the market this could be for that product? How about talking about their trials? They found another indication. I don't have it off the top of my thing, but they're doing a test for another type of wound care, which was the first time I heard of. Nobody asked a question about that on the call. No one. They didn't care, right? In my last call, I talked about this stock. I was like, okay, well, this is disrupting, porcine skin, right? This is disrupting pork skin. So I would have had questions about, say, the Muslim market. And so what about that product, in the Muslim world? That could have a huge impact, because of course, anyways, to me, no questions were asked about the long term. Only questions about the teeny tiny minor next quarter details, and frankly, this is the worst analysts have to offer, and this was Wall Street. BioStem, I wish this stock got much more respect. I really wish it did, because the product, in my view, I find it cool. I find it kind of fascinating. Turning placentas into bandages, that's a very cool idea. And as far as I'm concerned, they're the only ones doing that, and it's very innovative, and they have a very innovative process. But anyways, we care about 1% or 2% margin change on gross margin when you're going to go to 97, from 97 to 95 or 95 to 93. Over the long term, doesn't matter to me. The point is, the stock enterprise value is 180 million. Revenue is 302 million. They're going to predict it to grow that revenue by 80% this year. So this is a stock that's trading enterprise value with a forward revenue of a 0.33, right? So the stock is 3 times as cheap as its yearly sales of this year, and the gross margin is 97%. So outstanding stock. Happy to own it. It's risky. It's definitely risky, and it's a small allocation for me, and it could definitely go to zero. But given how cheap that stock is, I'm willing to take some of that risk. So anyways, this was not financial advice, not investment advice. This is just entertainment. Hoping you are entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.